Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
In this episode, Trishul and Aaron explore real estate as an asset class. They discuss individual investment properties, non-traded REITs, and publicly traded REITs. Real estate investments include equity and fixed income components, and they can have a low correlation to stocks and bonds. But it is the leverage that mortgages provide that makes all the difference. Even so, do you really need real estate in your portfolio? And now, onto our conversation.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area, and I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey Aaron, great to be here today, and thanks everybody for listening.
Great to be here as well. So the last couple of weeks we've been talking about asset allocation. We talked about the Yale model, stocks, bonds. We talked about some alternatives like commodities, gold, some of the hedge funds and alternative strategies. And one of the things we kind of pushed off that is both very involved in the net worths of many people, but it also kind of gets weird when we talk about it as a portion of asset allocation, is real estate. And this is a full conversation. We'll focus just on real estate because if you look at most household net worth, when you include their primary residence, that tends to be one of the bigger parts of their net worth. But you don't have to only have access or exposure to real estate in your primary residence. You can also invest in real estate. And so today we're kind of talking about real estate as an asset class that you would choose to invest in, more so than how real estate ends up being a big driver of household net worth. So one of the things that I like to think about real estate, or at least a kind of very brief description, is that real estate does appreciate in value, that property values do go up. And so you do get growth and you kind of realize return on the equity in the property. Real estate, if you're as an investment, also generates rent. So if you own the property, some either household or business is renting that property and paying you rent. So it does have both characteristics of equities and characteristics of fixed income. And as you start to evaluate real estate, it's really important to kind of understand both of these matter, and it kind of makes it this like weird middle ground between the stocks and the bonds, because it's not truly an alternative the way commodities are, but it is different than just a classic stock and bond portfolio. So we're going to try and talk about real estate investment trusts, REITs, R-E-I-T, both publicly traded and non-traded REITs. We'll also talk about individual investment properties and maybe get into that idea of like how to evaluate real estate as part of your net worth. So Trishul, you want to kind of start us off with, I guess, what is a REIT, or when you think of investing in real estate, what are the first few thoughts that come to mind?
Right. You began with an important point in the introduction, Aaron, the notion that a lot of households in the U.S. are already invested in real estate because they happen to own their primary residence and they might have a mortgage on it. But the notion is over their career or over their lives, that mortgage gets paid off. And ultimately, that ends up commanding a pretty large share of a household's net worth. And from that standpoint, yeah, real estate is quite common as part of the investment pie for the average American household. And in fact, given the fact that it's a way to kind of force this savings over time by creating this vehicle where you got to live somewhere, and a lot of people do end up owning their homes through various incentives that are provided by the government, it leads to this strong ability for wealth creation, air quotes. I'll explain why I said air quotes a little bit later. But it has, for at least the past generation or two, created a good amount of wealth for households, because at the end, you have this paid off asset that has the potential to provide value during retirement and beyond. But then, there's the question of, you can also invest in real estate. You can buy investment properties. And of course, the big issue there is it takes a lot of work. You got to go out and find a property. You got to figure out how you're going to manage this property, figure out the tenants and collect rent and stuff like that. We did a whole episode on managing investment property. But there's an alternative to investing in individual investment properties, and that's to do it from a more passive approach, that for maybe a little bit less active approach of investing in a fund that's job is to invest in real estate. And that's pretty much where REITs are. They're an investment company that owns, operates, or finances income generating real estate. And it's kind of modeled after the mutual fund model, but it's governed differently. It has different tax implications, which we'll also dig into. But at a high level, you're basically pooling money from a bunch of people, investors, and that money is used to invest in real estate. And then the growth in those real estate properties, that's one source of income, the appreciation in those properties, that is. And then also those properties do produce income, as you mentioned, Aaron. So that's also another stream of income. You can kind of think about it as, investing in a company, right, that has widgets. And if that company, sells those widgets and produces income, it will pay dividends, just like how a REIT might. And you might also think that that company might need to, take out loans to build a widget factory and stuff like that. And that's where, mortgage loans might come into play on the REIT side. So there's some parallels there. But at a high level, that's kind of what we're thinking about when we think about REITs. It's just a way to be less active in the pursuit of a return stream that's tied to to real estate.
Yeah, I think that's a great kind of comparison. And again, we've in the past conversation we talked about owning individual investment properties, but the idea is like, if you had $100,000 to invest, that could be a 20% down payment on a $500,000 property that maybe has one or two tenants if you get a duplex. And when it comes to real estate and investment properties, just on the residential side, a duplex tends to be better cash flow relative to the investment value. And so kind of the more tenants you could have, so a quadplex tends to be even better cash flow relative to your investment. And so kind of now you're thinking, okay, what if I could own an apartment building? So it's actually have 50 or 100 tenants. Well, my $100,000 investment isn't enough to make a down payment on an apartment building, but my $100,000 could be pooled with 10 or 20 or 50 different investors, and now we can buy several investment properties and buy several apartment buildings and benefit from the cash flow of having a lot of tenants. And that's kind of what a REIT is getting to, is that idea that instead of just you buying one property by yourself, you're pooling your money with other people who want to invest in real estate, and that allows you to buy those bigger, theoretically higher cash flow properties. But like you said, now you need to find property managers and marketing streams like to be able to fill all of those apartments. So you're going to have kind of higher maintenance issues. So it becomes that full business. Like if you're looking to get into this is not just one of your investments. If you're trying to own a large enough real estate portfolio, then it's a true business, and maybe that's not your full-time job. You don't want to do this, but you do want to participate in both the benefits and the equity, the fixed income, and some of the tax benefits. But you're going to hire a property manager, you're going to hire a marketing team, and you're going to hire a kind of finance team to go find the mortgages you need. But you also don't know how to find a property manager. You don't know how to find a good finance team. So you're actually hiring the fund manager, the REIT managers, where they will find those individuals or teams to do all that work for you. So it's kind of, you can kind of apply the same idea of owning that individual investment property. We're just scaling it up much bigger. Similar to the way if you could buy a stock yourself, you realize, oh, I need to be diversified. I'm going to buy a few dozen stocks or 20 stocks or 50 stocks, but I don't know which stocks to buy. So you would hire a mutual fund manager where you're pooling your money with other investors. And that way you can get these access to fractional shares, and you're hiring that mutual fund manager to choose those stocks for you. Kind of similar idea with REITs. So do you want to try and get it to publicly traded versus non-traded REITs?
Yeah,
Or
that's
is
probably
something you want to talk about first?
No, that's probably a good distinction to make. And that's just the notion that you might have REITs that are non-publicly traded and they just have investors that are more private. They're, a handful of people who have come together. They've raised money from another slightly larger handful of people, and they go off and do their REIT thing. But it's not traded on an exchange. These are all sort of private transactions. It's still regulated by the SEC. You still got to go through certain hurdles to make sure you're in compliance with the regulations, but you can list the ticker on an exchange. If you want to do that, then you would be, instead of a non-public traded REIT, then you'd be a publicly traded REIT, and that'd be just a REIT that is traded on a formal exchange. Now, you are definitely governed by the SEC with a lot more rigor and a lot more checkpoints. But at this point, it's just like any other stock or ETF that you might invest in. It has a ticker, its price moves up and down, and you can buy, one share or, 1,000 shares. And from that, you can participate in the returns that the real estate market gives. And of course, when you're talking about ETFs, there could be passively managed ETFs that try to just mimic the overall movement of REITs without trying to pick the winners. Or you can invest in a more specialized publicly traded REIT, which is more actively managed, where they might have some sort of mandate to try to beat that benchmark. And they'll likely charge a higher fee, but what they might be doing is they might be choosing some sort of subset of the REIT market and maybe specializing in some sort of certain area, maybe capitalizing on, like condos in Florida or hospitals in the Northeast and whatnot. So there's ways to kind of divide up the REIT landscape across these various dimensions. And if you're just looking for, again, a pure real estate return, you can get a passively managed REIT ETF. For example, the big brokers have access to these. Vanguard has one, like VNQ. It's just a ticker where you could buy, for like $100, $200, however much the share price is. You could access this market and be able to diversify across a whole basket of real estate investments for perhaps not too much. The fees on a passive Vanguard ETFs are around 12 basis points. So, 0.12%, which is not too bad for a passive index, a little bit on the high side, but not too bad. And it gives you access to this market, which is quite differentiated from your standard equity market or your standard bond market.
Yeah, I think when it comes to the fee side, again, I think it's important when you think of real estate, you have this spectrum with the individual investment property. There's no fees, but there's still costs. So, kind of if you hire a property manager, you have to pay the property manager actual dollars from the rent. There will be maintenance items. So if the water heater breaks, you have to repair the water heater. If there's a dishwasher breaks, you have to buy a new dishwasher for that place. And so you can, if you're really being consistent and kind of tracking all these things, you can track how much of the overall return in your property is going to these expenses. The next level will be kind of that the non-trade REITs. I think there's other factor is when it comes to thinking about real estate as an investment and kind of similar to why we include other alternatives, the hedge funds or the commodities, is these can provide similar returns to other investments but have less correlation. So if you own an individual investment property, the returns that you get have almost nothing to do with the stock market. It has to do with kind of local um, economics. If there's still jobs and people there to pay rent, that will kind of, if there's more demand, more people moving to their city, then rents can increase, but it has almost nothing to do with the stock market. So it's a very non-correlated asset class. If you get the non-traded REIT, where again there's no kind of there's no market for the stock, for the shares you own. It's you own a small share of all the properties, and so you might own 10 to 100 properties depending on the type of REIT, and you'll get a consistent dividend that they're going to pay out that they support from the rents in the in the investment. And a lot of times they'll try and target like a 6% dividend yield. That's a common target with non-traded REITs. But now again, you are hiring the actual teams of those investment managers, and sometimes the fees can be on the scale of 12 to 19% of your investment. Kind of as like you have the whoever's the advisor in this case, or whoever sold you the REIT, or whoever's getting that commission, or so you are paying that financial professional, you're paying the REIT company, and then you're also paying the underlying property managers, maintenance, all those things. And so they can get pretty expensive. But if everything's going right, if they're using leverage correctly for mortgages, then they can support that 6% dividend yield. And so it might be this kind of investment where you theoretically can get an equity-like total return on the scale of 8 to 10% nominal returns. And part of that is a 6% dividend yield, which is going to be greater than any other bond or even stock dividends. And so this can be a way to support a portfolio. But again, those are really, really high fees. And also because it's not traded, there's less correlation to other asset classes. But when you get to the publicly traded REITs, because they do trade on an exchange, the correlation to the US stock market starts to increase, where the economic factors and the headlines and all the news that influence stock market ups and downs will also affect real estate, publicly traded REIT returns a little bit. Not quite the same level. It's not a one-to-one correlation that you might sometimes get with like US large cap and international developed if there's a global financial crisis. But you do start to see headline news of things that are bad with the stock market imply things that are bad with the economy, which imply that people might be losing jobs, which might imply that there will be fewer renters. That can drive prices of REITs down, where a non-traded REIT, you only suffer if renters actually move out and you can't find that new renter. So with a non-traded REIT, as long as you have tenants, then your investment is consistent. Whereas because you haven't sold the properties inside that non-traded REIT, so you haven't realized any loss or downside. But with a publicly traded REIT, your investment will go down because the certain market effects that will drive a stock of a company going down, even if they haven't suffered from any economic downturns, will also affect that publicly traded REIT. So that's why kind of the real estate, when you look at these three categories, is kind of on a spectrum of non-correlation with that individual investment property, small correlation to stock markets when you have a non-traded REIT, but a publicly traded will start to have a greater correlation. And so it's kind of, if you're looking at a publicly traded REIT like the Vanguard, which will have those low fees, I don't quite know if Vanguard's fee number is accounting for the underlying expenses within the REIT. That's a little, I'm not quite sure of that. But even if you are getting those lower fees, you're losing some of those non-correlation benefits. And then if you're investing in real estate because you're looking for something other than stocks, you're kind of looking for that non-correlated aspect, then a non-traded REIT doesn't always necessarily make sense. Like kind of, if it also depends on your particular stage of life, and if you're looking for appreciation, if a theoretical best case scenario is real estate can provide equity-like returns, but with a higher dividend yield. So it's similar total returns, less price appreciation, more dividend yield, but you're still getting the same correlation, then sometimes a publicly traded REIT may not make sense for a growth portfolio. It might make more sense for a portfolio that's designed to generate income for retirees or people who are financially independent. But it's this spectrum of there are certain characteristics at each level that might appeal to other investors, but it doesn't necessarily make it the greatest thing ever.
Yeah, I think that's certainly insightful to understand about this asset class. And, frankly, the returns historically, if you look at REITs, aren't bad at all from one level. For example, if you look at, a standard equity index type of return, you might think like over the past, this analysis I'm looking at is looking back like 20, 30, 40 years or so. And, for equities, like in the stock market, it's averaged about 10 to 11%. And we're talking about total return here, meaning we want to think about the returns that come from dividends and the returns that come from capital gains or appreciation. And if you compare a similar return stream for real estate, well, over this similar period, it's returned around 10%. So, just around half to 1% lower than stocks, but 10% is a good return. A good amount of that return has come from the capital appreciation side, but some of it has also come from the dividend side. But it's also the notion that you're getting this leverage notion because you have a good amount of bonds and lesser amount of capital. So the growth on the capital itself that's invested, the equity side of the equation, gets to be accelerated if you're able to produce a positive cash flow and you actually get some appreciation.
That's a good point. Yeah, if I for some reason I remember seeing research that's like, I guess let's talk about the theory. Like, real estate theoretically should kind of match inflation. Like, I guess it kind of depends on population dynamics and is population growing, but the cost to rent something and should kind of go up with inflation. Therefore the kind of the owner should see the price appreciation or the rents increase with inflation. But when you start to add in leverage, which is very common with real estate, that's where you start getting these kind of equity-like returns. So do you want to kind of explain how mortgages provide leverage and how you would compare that to leverage in a business?
Yeah, I think that's probably an important distinction to make. So, a quick example with a mortgage and a house or an investment property is, let's say the investment property is $100,000. That's how much the house costs. If you put up cash and you put up the $100,000, well, in the course of a year, if it goes up 10%, you just made $10,000. However, if you took out a mortgage and you only had to put up $20,000 and you were able to borrow the other $80,000, and let's assume your interest rate is close to zero, and I'll explain why that might actually be true from some perspective in a little bit. But in that same example, that $100,000 house, you only put up $20,000, it grew by $10,000, your $20,000 had a 50% return. So that's not so bad because you used leverage. You borrowed money to make that happen. Now, there's no free lunch there. You kind of took on more risk, meaning if property prices drop 10%, well, then you lost half your money, half of your equity is gone. And if you were forced to sell when it's down 20%, well, then you're just wiped out. You had a negative 100% return. So it kind of does cut both ways, but in general, this kind of 1 to 4 ratio, 20,000 to 80,000 borrowed, is a common equity to debt ratio that you might see with a real estate investment. And what that means is you get this amplification of your returns by that ratio. And at a high level, again, with real estate investments, you're going to see this type of leverage eking its way into the returns. And one way to kind of think about this as an analogy to stocks is, well, for many companies, you have also equity invested in the company and you have some sort of level of bonds within the company. Now that might not be true for some like high-tech companies that aren't very capital intensive, but if you take your traditional brick and mortar company, like a manufacturing company that, again, let's say manufactures widgets, well, that company may have a value of $100 million. And at that point, the equity investors could contribute $100 million, or they can put in 20 million and borrow the other 80 million. And again, you see that similar type of math work out where if that 100 million goes up to 110 million, well, that 20 million the equity holders commanded, well, they just made a 50% profit. And if you held one share for $100, again, you made your 10% or your 50% by being an equity holder. You got that levered return. And that's similar to what you might see with a real estate investment, where you have the debt that's, producing a smaller return stream, and you have the equity, because it's a levered return, gets to amplify that return stream. So, for example, bonds we've mentioned before, they have about half the return of stocks. Well, you have bond-like investments in the real estate market. These are known as mortgage-backed securities or other types of debt-backed securities. Well, these are the bonds of the mortgage market or the real estate market. And they typically own a fraction of what the real estate investment earns, because, again, they're not the levered returns. They're just the return on the debt. And when you have the equity return, you basically get that return plus leverage.
Yeah, I think anytime I'm thinking about real estate, and again, making that comparison to a corporation's balance sheet, it's just sometimes remember, your equity by definition is the assets minus the liabilities. And so when you look at an individual investment property, it's the property value is the asset, the liability is the mortgage. So your equity is whatever your down payment was. And therefore, if the asset increases and the liability stays the same, your equity is increasing. That's where that leverage comes into play. Your example of the $100,000 property, your equity has increased 50%. Same thing applies to kind of any corporate balance sheet. You'll have assets minus liabilities equal equity, and that's what the total market cap of the company tries to reflect. So kind of it gets weird when you think of is the stock market determining the market cap of the company, or is it the assets minus liabilities? And this is kind of classic fundamental versus technical analysis. And the assets would include like the present value of future cash flows. But that's kind of what we're looking at when we're thinking about equity, is that it's those assets minus liabilities, and you could choose to have no liabilities, and therefore your equity equals the asset. But if you do add in liabilities, that's where you're getting some of this leverage. And I think we need to kind of explain why you get you're not quite counting the cost of interest on the liability, because most people are very aware of the interest that they're paying on their mortgage, at least the interest rate that they're paying, because it really affects their payment. But I think once we account for, I'm going to guess things like depreciation and taxes, but I'll let you explain that a little more. Like, why do we not really? Why is it an okay back of the envelope conversation to not quite include the interest?
Well, okay, so you certainly should include the interest. It's definitely includable in the map. But even if you did, it would have tacked off, a couple percent off of your 50% levered return. But also at the end of the day, what we care about is our real return, adjusted for inflation. So there's been a pretty high amount of um, liquidity injected or in the markets to keep interest rates low over the past generation or so. And, frankly, they've gotten to the point where they're so low that your real interest rate might be close to zero at this point. Well, given that we're at near 40, 50-year historical lows, for example, I just refinanced an investment property and my 30-year rate was like 3.125%. And if it and on my primary residence, another refinance, it was 2.3%, 2.4%. At that rate, if we have inflation at around 2%, your real rate of interest, subtract 2% from both those numbers, you get something pretty tiny. So we're at a point where what that encourages is a lot of people to invest in real estate. We've seen the prices of real estate go up quite a bit over the past year. It's been kind of open season on this, given the high access to this liquidity and the fact that rates are so low that you can borrow for 30 years at slightly above inflation with, just an average Joe being able to do that is pretty incredible. But what that does is it inflates the price of, or increases demand on real estate. It forces the prices up. And what that also does is it makes the appreciation on real estate outpace CPI. So that's something we brought up in a previous conversation on real estate, the notion that you would think in theory that the price of real estate should go up every year, it should appreciate in line with inflation. However, over the past generation, it's outpaced inflation by a factor of about 2x. So instead of 2% a year, we've seen about a 4% appreciation in real estate. And then you lever that up, and that's how you get a pretty nice return that we mentioned on actual real estate investments over the past generation or so. Now, one thing that I cautioned against way back then when we first talked about it is that really sustainable for the next generation, the next 40, 50 years? And the reason I called that into question is because what we've seen is, real estate has outpaced CPI by around 2% over the last generation. But what that's also meant is the cost of housing has increased as a percentage of an individual's income, a household income. Whereas in the past, it used to be close to 15% of an individual's household income or a family's household income. Now we're paying close to 30% to cover our housing payments each month, whether we're renting or we're owning, because of this outpaced inflation for housing in particular. And my concern is, if we look forward for the next generation, two things can happen. One is real estate continues to have the same great return that it did for the last generation and from an investment standpoint. But what that would mean is that the actual investments have done well because the average amount that individuals need to pay in terms of their housing payments would have also gone up if it outpaced CPI. Unless our paychecks also outpace CPI, but that's a whole nother conversation. But that hasn't happened either for the past generation. So the concern is that, if it's 30% of a household's paycheck going towards housing now, and that doubles to 60% for the next generation, we can't be spending all of our money on housing. We need to spend it on other things. So it's going to be, in my mind, challenging for real estate as an investment to keep up the nice returns that it has for the past generation.
I agree with all that. I do think that the key assumption there is, can wages and incomes outpace inflation? And like, if you think yes, then real estate can be just fine. If you think no, because it hasn't, then that would probably support your theory that we can't have housing costs continue to be a greater percentage of household income. But I think this probably gets back to, again, that spectrum between individual investment properties and publicly traded REITs. That's kind of at a national level where the publicly traded REITs are kind of big enough that they have exposure to so many different real estate markets around the country. And you can even get actually REITs that invest around the world, that most of those dynamics you say are true. But on the individual investment property, so much is determined by local dynamics. It'll be population growth, which will be kind of job growth in an area, and other certain local economics, that you could see national housing only increasing with inflation, or maybe even slightly less than that, but a local real estate market could be doing better if there is more people moving to an area. So you will see certain local real estate markets doing well because of the local demographics, the local economics, not necessarily the national demographics and national economics. So that's one thing I that's kind of why I do think of, when you're going to invest in real estate as a spectrum, for many of my clients, I usually don't include a publicly traded REIT in their portfolios, because if we're looking for the equity-like returns, we'll use the stocks. If we're looking for the income, we'll use more of a bond portfolio or total return strategy and a withdrawal rate strategy. But I am okay if my clients have their own individual investment properties, because the risk and reward dynamics are so different than the rest of their liquid portfolio. And it's not necessarily I'm going to recommend that they go out and find an investment property, but I think it is okay to own that. And I actually want to kind of use as an example, going back to the very beginning of our conversation, when we talked about how housing tends to be a really big proportion of household net worth. But I like the way you phrased it, kind of once you pay off the mortgage, you have this asset you live in. It's not generating income for you, but it is providing housing kind of for free, because you don't have a mortgage anymore. You've paid it off. You own that asset. You get to live in the house. You don't, separate from a reverse mortgage idea, but you don't really kind of access the equity in the house to support your expenses. You support your lifestyle because you live there, but it doesn't really support your spending. But it does get passed on to heirs and becomes a really big part of generational wealth. And so that's why I think people look at real estate in their home values, and it gets kind of, you're separating the net worth from your liquid portfolio that you can use to support your lifestyle, and it becomes that forced savings you were talking about. That if you're thinking about real estate as a way to grow your net worth, it's a good forced savings, but it's more likely to help your children than it is to help you grow your own net worth. They're depending on a variety of assumptions and variables. Theoretically, if you were to take the money that you would spend on a down payment on a property and you invest that and got equity returns, but you continue to pay rent, but your rent would also be less than the mortgage payment, you could make both of those work. You could rent for the rest of your life, or you could buy a house. You pay the greater mortgage payment for 30 years, or you invest what was the down payment, you pay a lower rent, and you save and invest that difference. Whatever your mortgage was going to be, if you have the discipline to save and invest the difference between that mortgage payment, it's like mortgage payment, property taxes, insurance, maintenance, all those other expenses. If you could really make sure to save and invest that, then it gets pretty close. Depending on your variables and assumptions, you can make kind of either one work out, but it's close enough that I like to describe the house you live in is not a is not going to be a big driver of your net worth because you're living in it. Like it's okay to rent, and you can, if you have the discipline to save and invest, you can make that part work out. But it is going to be that forced savings, because like what we talked about, like you're not going to spend down your principal on your house. You're not going to try and rent out just your garage while you're living in the rest of the house. It becomes a forced savings that gets passed on to heirs. I think that is a distinction when it comes to thinking about real estate as a driver of household net worth. The only kind of caveat to that would be if you sold the house and moved somewhere else. That might be somewhere where you actually are accessing the equity in the house. So being in California, I've seen this play out several times, including my parents, where you bought a house in California, you saw really amazing appreciation over the last 20 years, you sell the house and move to a different state. You move to Arizona or Colorado, where the cost of living is so much lower, so the home values are so much lower. That's an example of how you could access the equity in your house to support your lifestyle. But if you're planning on living in a house for the rest of your life, then realistically you're not benefiting from that big net worth driver. It's a good forced savings, and it gets passed on to heirs. It makes a big difference in generational wealth, but not necessarily your own net worth. That's kind of a distinction between housing that you live in and investments, and real estate as an investment. So you want to kind of add anything to that thought of generational wealth, investing in real estate, whether it's kind of separate from your commentary on is real estate a good investment moving forward over the next generation, but other dynamics of kind of when you have clients that have real estate as part of their net worth or part of their portfolio.
At the end of the day, there's a lot that can come, just psychologically from owning your own home. So that might be enough of a tiebreaker to tip the scales for most people. But yeah, I think I'd kind of agree with what you said. If you played out both scenarios over long periods of time, the renting versus, taking that extra money and investing it as compared to, owning a home and getting forced savings, it probably does come out to about the same, depending on the time period you look at. There may not be a significant winner. And at the end of the day, there are also incentives for owning a home. As we mentioned, the government does like to keep our interest rates low, but also there's all these tax breaks you can get. The ability, if it's your primary residence, to deduct your interest payments, and also the notion that if you have your home and you sell it, well, you actually have the ability to get a deduction on the gains. Mm-hmm. If you're married, that's $500,000 that you can deduct. So that's a good amount of gains. If you you and your spouse purchased a house for $200,000, a few years later, many years later, who knows, sell it for $700,000, you have $500,000 of gains. Well, zero tax. Look at that. Now there'll be some depreciation and some recapture of that depreciation, but that's another conversation. But at a high level, that's $500,000 worth of taxes or gains that you don't have to pay taxes on. So not too bad as a market. And if it's an investment property, you have this whole notion of a 1031 exchange. And, this is the notion of if you are investing in real estate this time and you find another property that let's say costs more, well, you can do an exchange such that you can roll your investment from one property to another property without creating a taxable event. So you can kind of keep upsizing your properties without having to pay taxes on the capital gains from one property to the next. And that's a pretty good incentive to think about.
Yeah, I think the depreciation also, kind of a quick note, with the non-traded REITs, that's one of the ways they get sold, very easily, is that we're going to get you a 6% yield plus some equity upside. And because of the depreciation and the way that the REITs pass through all of the income and all the deductions, for the first several years, the 6% yield you can get may be tax-free. And so that's how they get sold easily. But like eventually, if the property gets sold, the REIT gets sold, like there's some recapture, so it's not as rosy as the picture gets painted. But yeah, depreciation can come into play to provide some of those tax benefits.
Yeah, depreciation is kind of the pickle, because you do kind of see a line item of depreciation as a deduction, but you have to realize there is a recapture component when you go to sell. And frankly, real estate is a depreciating asset. It's typically the land that goes up in value. And yeah, the home can, depending on what happens, but that to get that appreciation in the home, there likely has to be a good amount of maintenance that has to go into the home to keep it and fair value compared to a new home in that area. So over the life of a home, 30 years, that can add up. So at the end of the day, depreciation may be kind of mock nicks in terms of the benefit you get from the deductibility of those funds, but at the end of the day, you do get that interest deduction, which, as I mentioned, with interest rates so low, what is your real rate of interest then? And if you factor in the deduction and the fact that they're so low, it does provide a good incentive to go out and buy some more, property. And, part of the stories we've been reading is over the past year, a lot of what's been happening is developers have been amassing great amounts of properties, and real estate moguls have been expanding their holdings, which has also been leading to a large drive up in the prices that we've been seeing, given the access to liquidity. So it's just one of those things where it's been kind of great. Let's hope it stays that way, maybe. I don't know. But one thing to realize is also over the past generation or a few generations is the population has been increasing. What happens when you have less people buying the same number of homes? Does that keep the prices going up as they have been? So just something to think about. And then finally, the last thing I'd probably mention with the taxes is, with real estate in general, the taxes can be efficient from the perspectives that I mentioned, but it can also be quite inefficient from the perspective that I didn't mention, but I'm about to mention. And that's the fact that, for example, if you're collecting rent and you have positive net income, well, that's income that's charged at ordinary rates, which is higher than your qualified dividends or your capital gains rates from the equity market. So that's something to keep in mind. And when we're thinking about a REIT and the dividends that you get there, well, most of it is actually going to be that type of income that's ordinary. And that means it's going to be taxed at the higher rate than you would have from a typical capital gain or qualified dividend. There could be still some, appreciation and other ways to get that lower rate, but a good bulk of the income that you get, or the dividends that you get, air quotes, from a REIT would be taxed at that higher ordinary rate.
Yeah, that's good. Like if after all the depreciation has passed through, yeah, the higher yields would be taxed at higher rates. And if you're reinvesting the dividends, if you don't need that money for current lifestyle, then yeah, that can be a kind of tax inefficient way to see your portfolio grow.
Yeah, one small thing we didn't mention is that the REITs are required to distribute 90% of their income. That's just part of how they're set up. So even if they wanted to reinvest that money and not pass it out, they kind of have to by structure.
Yeah, so like they have to pass it out. You can choose to reinvest back in that REIT, but you can also choose to reinvest those dividends wherever you wanted. And so that's like you're still paying taxes on it either way.
Right. So the taxes do get a little tricky as well, because with the REITs, you do get the ability to qualify for the QBI, the 20% off of the pass, or 20% deduction on the pass-through income. So that's something that was included in the Tax Cuts and Jobs Act that was signed by a president that happens to have a lot of real estate, but I don't know if that had anything to do with it.
That's interesting. Well, that was a good conversation on real estate as investment. I think it ties in well with our conversation last time about owning individual investment properties, but also the last few weeks as we've discussed asset allocation. Is there anything else you want to add, or do we get all the bases?
I think we covered a good amount. I think at the end of the day, if an individual doesn't have access in the current portfolio to the real estate return through their personal property, or some sort of inheritance or some sort of investment type of property, the REIT itself is not a bad return stream. It's just a question of what does one think that return stream would be on a go-forward basis. And I did raise some concerns, but that doesn't necessarily mean that it would be a poor investment in the future. That's
a great way to phrase it. That it's not a bad investment. In fact, it could even be a good investment, but also just investing in the S&P 500 could be a good investment. So it's definitely not a necessity. You don't have to go out of your way to make sure you have real estate in your portfolio. If it's either kind of too expensive, it's administratively too much. Again, it's not bad, but it's not the be-all, end-all that some other financial gurus will recommend. It's just another investment.
Right. Good stuff, Aaron.
Well, thank you, Trishul. I really appreciate the conversation today.
Thanks, Aaron. I enjoyed digging into all of this. And thanks, everybody, for listening. If you're enjoying these conversations, do spread the word. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.